forgive my profanities this evening. Insight. The insight I'm going to give you is this. You want a process, you want discipline. Why? Because then I'll control your mind and your emotion. You get a good night's sleep. Getting a good night's sleep is actually a very good way of getting a decent pension. Your brain is geared towards protecting you. And so getting a good night's sleep is actually a really good column in the, do I want to own this stock? Will I get a good night's sleep? By the way, Buffett does that if you think about it. I know I keep mentioning him. It's because I don't want you to trust me at all. I want you to cross-verify everything I say, either by somebody or something you know from the great man himself, or from the logic of what I'm going to be telling you. Don't trust me for anything. Why should you? Management, money, how much do we put? Generally about 20 stocks, equally weighted. Sometimes those weightings might differ, but at least 20. Might have up to 40. Beyond 40, pointless. If you're risk averse, you might hold more cash. You might hold some really low volatility exchange traded funds, and you might have some money in bonds, which I generally tend to do through either Flagstone or Wise, because they just automatically put it into a bond portfolio for me, and I don't want to be picking bonds because it's not my speciality. Okay, drawdowns. How much could it fall? I'll show you this in a second. You've got to know that. It's pretty easy, actually. Then expansion. Okay, what's expansion? Well, you might add to winners. You might have 2 times leverage exchange traded funds. Don't do that. That is for experts only. You might scale in to your positions, start small. That's just clever tactics and techniques to use. And of course, diversification, which really means we've got to make sure non-correlation. We don't want a bunch of correlated stocks. Contrary to what you think, cross-industry can be less correlated than within the same industry. Okay, what I mean by that is Microsoft and Apple can be less correlated to each other than Microsoft and Costco. Don't assume that just because things are in different industries that you've diversified all of a sudden. Diversification is not what you think. It's not what Grandpa taught you when in the 1960s industries were diversified. Finance was different to oil and gas. Nowadays, in a very connected world, things are more connected than you'd realize on the stock market. So when your IFA says, well, don't put all your eggs in one basket, you want a bit diversified, get a bit of Vietnam, get a bit of US. No, they're selling you more shit. That's not. Show them, where's the cross correlation figures? And they'll just look at you blank and then run. Okay. Duration, 12 months minimum, because you've got to give it some time. You've got to give it some time. 3 to 5 years, even better. Okay, as long as they're quality companies. The longer you give it, if they're quality, easier your life is. Simple as that. Most of my students will minimum want 12 months. A lot of them are also comfortable with 3 to 5 years. And you want a process. Like I said, process, this is a process I give my students. Very simple process I give my students. Okay. Watch out, take a picture of this if you wish. Watch out for that bit. Don't do too much of this. Otherwise, you're going to be trading your investments, i.e. under 12 months, decide all of a sudden I'm risk averse and start selling. And if it does drop a lot beyond what you expected, then you shouldn't have bought it unless you are happy to hold it. Again, Warren Buffett test. If they turned the stock market off and you had to hold it for 5 years, would you be happy? That's how you know, is it quality? That's what forces you to make sure it's a quality company. And the other thing he often says, which is if you can't handle a stock dropping 50%, you've got no business being in the stock market. So unless it's one of those. Now, I've got students who say, no, we're going to go with the 12 months, 25% stop loss because they want to have that certainty. That's higher risk, a shorter time frame, smaller stop loss. It's higher risk than 3 years, hold the portfolio because they're quality companies. Obviously, self-definition. But they like the certainty of timeline and they like the certainty of the stops. Either way is fine. What's actually happened is we've done model portfolios based on holding period for at least 3 years. They've been proved more popular than the 12 months, 25%. So it just goes to show that actually given the choice, contrary to what I thought, people preferred the longer holding period and the no stop loss period within a portfolio. One of my mentors, I'm going to give you a copy of this book, Mind of a Trader, Lessons in Trading Strategy from the World's Leading Traders, is Bill Lipschutz. He was at Salomons when Warren Buffett was his chairman. You can download it for free from there. Okay, so I just want to let you know, reconnected poll lost. Apologies. That probably explains it. I think there is some there's some IT stuff going on. So I've put the poll on. Let me just pause syncing on a few things as well. Just making sure that I'm not using up lots of bandwidth. There we go. So the poll's up. Apologies, I thought it was a bit weird. So if you want to download it, then it's there. Okay, guys.